Hi everyone, my name is Chris. Welcome to this channel. Today, I will talk on the topic of auditing trade finance and walk you through the critical areas that demand our attention when auditing trade finance. Trade finance is the lifeblood of global commerce, but it's also a high-stakes area fraught with risk. A robust audit isn't just about compliance, it's a vital shield against financial loss and reputational damage. Today, we will break down this complex field into 5 key focus areas. We will start with the foundation of governance and risk management. Then, we will dive deep into the core products, letters of credit and guarantees. From there, we will tackle the ever-critical area of financial crime compliance. We will examine operational and financial controls. And finally, we will look at the modern landscape of supply chain finance. By the end of this session, you will have a clear, structured roadmap for conducting an effective and efficient trade finance audit. Let's begin. Our first and most fundamental focus area is governance and risk management. This is the bedrock upon which everything else is built. If the foundation is weak, the entire operation is at risk. Here, an auditor must ask key questions. First, are there clear, up-to-date, and comprehensive policies and procedures for every trade finance product? These manuals shouldn't just sit on a shelf. They must be living documents, accessible and understood by all staff. Second, we look at organizational structure. A critical control is segregation of duties. We must verify that no single individual can initiate, approve, process, and reconcile a transaction. For example, the person who issues a letter of credit should not be the same person who approves the payment against documents. This is a primary defense against internal fraud. Third, we assess the overall control environment. Is there active oversight from management? We review committee meeting minutes to see if trade finance risks, performance, and errors are regularly discussed and addressed. Finally, we must ensure that the bank has a robust framework for identifying and rating the inherent risks in its trade finance portfolio, considering factors like client types, geographies, and products. The audit must test if the controls in place are proportionate to these risks. In short, a failure in governance makes every other control less effective. Now, let's move to the heart of trade finance: auditing letters of credit and bank guarantees. These instruments carry significant contingent liability and are prone to documentary fraud. Our audit approach here is a life cycle review. We trace a transaction from birth to death. For letters of credit, we start at issuance. We select a sample of LCs and check. Was the application complete? Was it properly authorized by an officer with the correct credit authority? Were all fees calculated correctly? But the most critical stage is documentary examination. This is where the auditor must put on their investigator's hat. We re-perform the document check. We take the presented documents, the invoice, the bill of lading, the insurance certificate, and scrutinize them against the terms of the letter of credit and the international rules, primarily UCP 600. We look for discrepancies. Was the bill of lading marked on board? Was it clean? Are the dates consistent across all documents? More importantly, we audit how the bank handled any discrepancies found. Were they properly communicated to the applicant? Was payment made against an indemnity? And if so, was it justified? For bank guarantees, the process is similar. We audit the issuance to ensure it's based on a valid underlying contract. But the key audit test is on the claim. We scrutinize every claim received. Was it within the validity period? Was it in the exact format required? Was it paid only after rigorous verification? A paid claim against an invalid guarantee represents a direct financial loss. In this area, the auditor's mantra is, trust but verify the documents. Perhaps no area has seen more regulatory focus in recent years than financial crime compliance. In trade finance, the complexity and volume of documents provide a potential veil for illicit activity. Our third focus area is a deep dive into anti-money laundering, sanctions, and know-your-customer controls. The first line of defense is sanctions screening. An auditor must test the bank's automated screening system, but we must go beyond a tick box exercise. We need to verify that the system screens all relevant parties in a transaction, not just the applicant and beneficiary, but also the notify parties, the vessel name, and even the issuing and advising banks. A single missed name can lead to a multi-million-dollar regulatory penalty. Next, we have anti-money laundering. Trade-based money laundering, or TBML, is a major threat. Auditors must look for red flags. These include over or under invoicing of goods, phantom shipments where no goods actually move, and transactions that don't make economic sense, like shipping seasonal goods out of season. We test if the bank staff is trained to spot these red flags and, crucially, if there is a clear process for escalating and investigating them. Finally, we audit the KYC Know Your Customer files. We select a sample of client files and check if they are robust, up-to-date, and that the client's risk rating reflects their business, geographic exposure, and transaction patterns. A high-risk client involved in commodity trading with high-risk jurisdictions should have enhanced due diligence. In this arena, a strong audit is the bank's best defense against becoming an unwitting accomplice to financial crime. Our fourth focus area ensures the engine of the Trade Finance Department runs smoothly and accurately. Operational and financial integrity. This is where control failures can lead to direct financial loss or significant operational disruption. We focus on several key controls here. First, fee income. Trade finance is a fee-based business. We must test that all fees, commissions, and charges are being correctly calculated, applied, and collected. Missing income is a direct hit to the bottom line. Second, we audit account reconciliations. Trade finance operations use several internal or suspense accounts. We must verify that these accounts, including the nostro accounts with correspondent banks, are reconciled frequently, ideally daily, and that any long outstanding items are investigated and resolved promptly. An unreconciled item could hide an error or even fraud. Third, we check physical controls. This includes the custody of secure items like blank, letter of credit and guarantee forms. There must be a strict logbook tracking the serial numbers of each form issued, used, and voided. A missing form is a severe risk. And finally, we look at system access controls. We need to ensure that staff only have the system permissions necessary to do their job, aligned with the principle of segregation of duties. An operator should not have the ability to also approve exceptions in the system. While these areas may seem less glamorous than chasing financial crime, a failure here can be just as costly. Our final focus area brings us into the modern era of trade finance. Supply chain finance, or SCF. While it offers great benefits, it presents unique audit challenges that differ from traditional products. Supply chain finance audits revolve around three key pillars. First, onboarding. We audit the due diligence process for both the anchor buyer and all the suppliers. Are the suppliers properly vetted? Is their connection to the buyer verified? This is critical for preventing fraud. Second, and most importantly, invoice authenticity. The central fraud risk in SCF is financing a fake invoice. Our audit must test the controls that ensure an invoice is valid. We check. Is it uploaded by an approved supplier? Has it been approved for payment by the anchor buyer through the platform? And crucially, are there controls to prevent the same invoice from being financed twice, a classic double financing scheme? Third, we look at rebates and fees. The calculations for early payment discounts and program fees can be complex. We need to verify their accuracy through sample testing, ensuring that the bank's income is correctly recognized and the suppliers receive the correct amount. Auditing supply chain finance requires a blend of traditional credit audit skills and a deep understanding of this digital, platform-based ecosystem. As we bring this to a close, let's recap the key takeaways. A successful trade finance audit is not a random check of transactions. It is a structured, risk-based journey through 5 critical domains. 1. Verify the governance foundation is solid. 2. Perform meticulous lifecycle testing on letters of credit and guarantees. 3. Be relentless in testing financial crime compliance controls. 4. Ensure operational and financial integrity in systems and accounts. And 5. Adapt your approach for the digital risks in supply chain finance. Remember, your role as an auditor is not just to find what is broken, but to provide assurance and insight that helps the business grow safely and securely in the complex world of international trade. By following this structured approach, an auditor can provide valuable assurance that the bank's trade finance activities are conducted in a safe, sound, and compliant manner. This concludes our sharing. Thank you for your time and attention. If you found this video is useful, please do share it out with your friends, colleagues, and feel free to subscribe our channel. Thank you, and have a nice day.